Hey everyone, this is Kirk here again at OptionAlpha.com. Thanks so much for checking out this video alert that we send out each and every night on the membership side of our blog. So we're going to go over both the opening and closing or adjusting trades. And now that we're getting really into kind of the last 2 days of expiration for April options, we'll start to talk about some of the options that are going to expire, some profitable, some in the loser column over the next 2 days. So let's first go over the closing trades before we actually talk about the opening trades, because those were at the end of the day here, and I want to talk about the kind of logic behind placing those trades right kind of before earnings for both of those. So for closing trades, we actually closed out of BAC, which was Bank of America. This is one that was a real tough one. It was one that we were actually trying to roll for a couple days and just really had to kind of bite the bullet on this one and close it out for an $88 debit or a $61 loss per contract. Really, at the end of the day, Bank of America just didn't have as great of earnings as we just kind of hoped they would, because we were short a put spread. So we were hoping that Bank of America stock would rally higher. And you'll notice on the chart that today's actual earnings weren't as good as we would have hoped for Bank of America, and the stock just continued to kind of fall a little bit towards the end of the day. So no real meaningful move in the stock. We actually needed to close more up around 1675 or so. So a pretty big move for one day for this stock to make now after having bad earnings. So I don't expect this thing to actually get anywhere near profit anytime soon, obviously with a day to go. So at this point, we're going to close it out, save about 22 cents or save about 12 cents in potential extra loss if we let this thing go all the way to expiration. It'd be worth $1 in a debit tomorrow, so we closed it out early today at 88 cents. WFM is one that we actually closed out today for a profit. This is one that we actually haven't had too long. It's about a 2-week trade that we've had, and we originally had sold the 55.60 on Whole Foods market, and Whole Foods just continues to move lower. It does have earnings coming out, but at the same time, we've a little over 50%. Especially with earnings coming up, we have no idea where the stock. There's no. Now the other one today worthless, and this one's just a day earlier than most of the other contracts, but this is our VIX trade. So we actually had sold a 17.19 call spread in the VIX. Now, if you remember, this one was a little bit more exotic because actually the VIX was trading around 17.5 when we actually sold the spread. So it's kind of weird because we actually sold a credit spread that was in the money. And I usually don't ever do that, except the VIX is a little bit different because it's kind of just so driven downward with low volatility. So this is one that expired worthless today. So we made $50 on each of the 2 spreads that we sold. So it was a nice $100 profit, a very easy trade. Honestly, I wish I could make this trade every day of my life, but the VIX just isn't as high as it usually is. So as soon as it starts popping up to 18, 19 again, we'll start making these trades. We've been very, very profitable trading the VIX this year, but you just have to wait and pick your entries on the VIX. The 2 trades that we had today, so both of these are the same type of trade. So we sold a credit put spread in LinkedIn and Netflix. Now both of these have earnings that are coming up, and so implied volatility is very, very high for both of these. Now, typically when we're selling options around earnings, we like to do something like a strangle or a straddle or an iron condor or a butterfly. So something that's even on both sides, so you're kind of getting this non-directional play in earnings. But here's what we have in our portfolio right now and why this makes sense for our particular portfolio and positions. We already have a lot of positions right now that are taking advantage of the market going down. So we've continued to add yesterday and the day before, we've added positions that are negative delta positions. So we want the market to go lower. Now we've also added some positions where we want the market to go higher. And so we started to see some profits in those as well. But we are a little bit more tilted towards the bear side right now. So at least at this point, these are kind of more of not lottery tickets, but they're more of a calculated bet that we want to see both of these potentially pop up after earnings. They've had a huge downward move in the last month or so, and implied volatility is very high. So on both of these, and we'll go over them here in a second, we're still very far from where the market price is. So we still leave a little bit of room for earnings, and we know we're going to get a volatility contraction after earnings come out because it's just usually what always happens on these big name stocks. So let's first go over LinkedIn. So LinkedIn, we went ahead and sold the 155, 150 credit put spread and took in a credit of about 132 on each of those spreads that we sold. So if we go to LinkedIn, you guys can see exactly where our positions are. Let's just type in LinkedIn's ticker here. And you'll see that it's made a low around 158 and it's kind of bounced off that low. And so we have earnings on the horizon. And look, implied volatility is crazy high in LinkedIn right now, up at the 95th percentile. So it's very, very likely that this thing is going to see a major decline in volatility right after earnings, probably down to around 40 or 50, which is still going to be a huge move in volatility for a one-day event. But you'll notice that the lowest strike, at least on our chart right now, is 160. So we're about $5 below that, and that's our first strike. So we're leaving ourselves about $15 of room here between ourselves and the market, which right now is a pretty good safe bet. And again, we want LinkedIn to go higher. So we're going to kind of play that upside move in LinkedIn. For Netflix, it's almost the same thing. So we went ahead and sold the 290, 285. So it's still a $5 wide strike, just like LinkedIn. And we only sold one of these, but we sold it for a credit of 105. So took in a little less premium. We're actually trying to be a little bit more conservative on Netflix because it does tend to jump a little bit more than LinkedIn after earnings. So we sold the 290, 285 on Netflix. So let's go to Netflix so you guys can see that. And obviously you can see just how big of a move down the stock has had and just is really starting to find its footing here in the last couple of days where it hasn't really let itself sell off anymore. And Netflix has earnings that's coming up very, very soon. So we do have an opportunity to see a very quick move in implied volatility down after earnings come out. But where do we make these trades? So where are these actual options positions as far as profit and loss? Well, here's a look at where Netflix is. So we obviously have that April contract that's just going to expire worthless. We're going to lose money on that one. But for May, we entered this position today on the 30-day mark because it's just the next month out, right? It's more of an earnings play, so there's no need to go all the way out to June because we're not making a huge, huge directional bet. 30 days is plenty of time for this trade, and right after earnings, we should see a bulk of the profit come in if we're right on the direction. Now, here's where our position is for Netflix. So I'll just kind of circle this so you guys can see it, the 295, 285 credit put spread. And you'll notice that the first strike is at 26%. So let's just call it an even 25% so it makes it easy for math for all of this. And basically what this is saying is that the probability that Netflix trades down to and closes below 290 by expiration in May, which is 30 days away, is about 26%. So about 25% chance that we're going to lose on this trade. That means if you flip that around, we have a 75% chance that this becomes a winner. So we're taking this trade a little bit more conservative. So we moved out to the 75% or 75% probability range. We usually like to make our credit spreads around the 70% probability range, taking in a credit of about 1/3 the width of the strikes, or about 30%. So at this point, we're just being a little bit more conservative. That's why we only sold one. Netflix is a big jumper. And that also leaves us room to add to this position if we need to. So since we only sold one spread in here, we actually are kind of underinvested for what we usually do in a position size. So that leaves room to go ahead and sell a call spread or add to this put spread right after earnings if we need to hedge or adjust this trade going into it. So, but again, this is really kind of fitting into our overall portfolio that we wanted to see Netflix continue higher. We have a lot of negative delta trades on right now, so we needed to add some positive delta. And what better way to do it than these trades that are very, very liquid and very, very high probability trades with implied volatility so high before earnings. So these will be interesting ones to see come up on the earnings deck, and obviously ones that we're going to watch really closely and continue to send out alerts. If anything happens with these, we'll obviously send out alerts for closing or hedging or adjusting, whatever the case is. So as always, hope you guys really enjoy these videos. Please add your comments below here. Let me know what you think. Ask as many questions as you want. I'll get back to all of those tonight or tomorrow before the open, and happy trading.